Anyone who's ever done anything worth doing has dreamed big, failed mightily, and mostly started from humble beginnings. This is a podcast about such people. The most fascinating podcast in the world is fascinating because of the stories of the human beings. Hello, everybody. It's Pat DeCerbo, the most fascinating podcast in the world. Nothing to do with me. It's fascinating because of our guests, and there is nobody more fascinating than Dave Breazzano, who we have here today. Dave is the co-founder of Poland Capital's credit franchise, which he founded in 1996 as DDJ Capital, where he built the boutique firm into a premier credit manager focused on high yield and special situation investing. Dave is currently the head of the team and the portfolio manager for U.S. high yield at Poland Capital. Before DDJ, Dave was at Fidelity and ran the Capital and Income Fund and co-managed the bankruptcy and distressed investment area. Before that, Dave got his MBA at Cornell, and before that, Dave graduated from Union College, Schenectady, New York, otherwise known as the finest liberal arts college in America.
With engineering.
With engineering, yes. Dave has 3 sons, Jeremy, Matt, and Mike, and 1 granddaughter, Ava. Dave is married to Denise, and Dave has 4 siblings, a brother and 3 sisters. Dave hails from Northville, New York, not far from where I grew up, although we did not know one another growing up. I knew Dave's mother because I unwittingly met her many, many times as the owner of the Catch-All, which had literally anything you could want. Welcome, Dave.
Well, thank you, Pat, for having me.
Oh, my pleasure. This is going to be great. It's not every day that I have famous people on.
We'll see about that.
So I always ask everybody this. It's kind of funny, but what are your earliest memories, like from when you were a little kid?
Oh, they go back pretty far. So I was born in New Jersey, and I have an older brother, as you mentioned, and 3 younger sisters. And I actually remember my sister, the oldest one, who's 2 years younger than me, when she was a little baby. We lived up on top of a gas station. My father owned and ran a full service station in New Jersey. And at that time, with just 2 boys, we lived upstairs over top of the gas station. And I remember that.
That's incredible. How long did you live in New Jersey?
We lived there until I was 8 years old, and then moved to upstate New York, the Northville area.
Mm-hmm. So were you a family of 7 at that point? Were there all 5 children were born at that point?
We lived on top of the gas station, as I said, and it was my brother and sister who was just a little baby. Then we moved to a little bit larger house and I had another sister. And then we moved to another larger house in New Jersey and had our last sister. So the 5 children and 2 parents moved to upstate New York in 1964.
Okay. What do you remember about when you first arrived in Northville?
It was a small town. So my father, who, as I said, had a gas station, also was into flying. And he got a pilot's license and actually built his first aircraft. It was a twin-seat Piper aircraft. And he decided he wanted to own and operate an airport. And so he bought a dairy farm in upstate New York, several hundred acres. And it was on 2 sides of a road, Route 30. And the one side, he created, probably a 3/4 mile long grass runway strip. The other side still had dairy cattle on it. So we moved up there and lived in this extremely rural area, no near neighbor. We couldn't walk really to our neighbors. And then we went to school in Northville, which was about 5 miles away. So it was small compared to New Jersey. I grew up in a town called Pompton Plains, or I was born in Pompton Plains, which is outside of Patterson, so a little bit more urban area.
Mm. Okay. And then what were you involved in at that point? Were you involved in sports, or what'd you do for fun
Well,
as a
we did
little
a lot
kid?
of outdoor things. There were no Game Boys. I think we only had two channels on television because we were so far away from a major city. So it was a lot of outdoor activities, running through the woods, playing different outdoor games with people that could come over. And then as I got older, I played little league baseball, and then in high school I ran track and cross country, and spent time. Yeah, I was actually even on a bowling club for a while, just to do things. And then, when we're home at night, ran around in the woods and played with the neighbors that were had to ride their bikes to get to our house.
I've seen your bike. Your bike weighed a ton.
And you bought it, and I
I did. I
appreciate
bought
that.
it. I bought it at the garage sale.
It made
I
your legs
st-
strong.
I still have it, as a matter of fact. I should have
Very
brought
good.
it over here, but so at what point did you decide? So you're living in this small town. Were you encouraged to go to college by your mom and dad, or like what were you thinking as you went into middle school and high school?
Yeah, so I should step back a little bit. My parents did get divorced. I
Mm-hmm.
think the move to upstate New York created a strain running the airport, and then my father put the gas station in the hands of uh, someone else who mismanaged it. So he had to go back down to New Jersey to run it, and then try to come up on the weekends to manage the airport, and that created a strain. So without getting into the details, they ended up getting divorced. And a few years later, my mother remarried. So we moved on the other side of Northville to the town of Edinburgh, where Pat was familiar. And
Mm-hmm.
my mother ran the catch-all store that was this historic building in front of our house.
Mm-hmm.
So we moved to about 75 acres, so still a very rural area. But what
Mm-hmm.
my mother did, and she told me this years later, is she was advised by our pediatrician that she always wanted her children to go to college because she never did. And it wasn't common, certainly for females, to go to college back then. But my uh, biological father and stepfather never went to college either. They were blue collar workers, essentially. But she wanted her children to go. So it was always assumed we would go to college. She would talk about, well, when you get through high school, what college do you want to go to? What kind of profession do you want to be in, and so forth. So as kids, we just assumed we were going to go to college. We didn't know there was a choice, and it was clever on my mother's part. So I knew that I was going to go to college. My parents were not college educated, so I looked around in my family, and what I considered the most successful financially in my family was my grandmother's brother, so my great uncle, who had gone to Union College and got a very successful job. He was at what was called International Telephone and Telegraph, ITT, which was one of the early conglomerates, and he was one of the pioneers in the M&A business, where he was in charge of their acquisitions, working with Harold Janine, and
Hmm.
bought companies like Sheraton Hotels, Hartford Insurance Company, and so forth that IT&T acquired, which was kind of revolutionary at the time. So my one experience of a relative who went to college was Union College, and he did quite well. So I wanted to go to Union College. Um,
Mm.
did some research. We were not a wealthy family, and I discovered that there was George Mosier Scholarship. George Mosier grew up in my region, the Northville area, went to Union College, became very successful. He was the founder of General Electric Credit Company,
Hmm.
which was created during the Depression to loan money to consumers so that they could buy appliances from General Electric. And it became a very successful finance company. But he endowed a scholarship that paid my entire, more than tuition to go to Union College. And it was allocated first to a family member, and then second to someone who went to Northville Central School, where I graduated, and then someone from Fulton County, which was the county that Northville was in. And then after that, I think I went to somebody who graduated from Scarsdale, where he lived because of GECC. So I applied for that scholarship and was fortunate enough to be awarded it. And I also applied to Union College when I was a junior in high school and was accepted at the start of my senior year. So I only applied to one school, got in before I was really a senior in high school, and had a full scholarship to attend Union. So that's what set me on my way.
Did you finish high school or just go right to college?
I finished high school. It was predicated on finishing high school.
Gotcha.
But it certainly took the pressure off my senior year.
No doubt. So you got to Union. What was that like when you got there?
To me, Union was a big school. I had 56 kids in my high school graduating class. And Union, which is considered a small liberal arts engineering college, I think had probably 500 or less students in the class and was considered small. To me, it was huge. So it was a bit overwhelming. It was only about 35 miles from my house, but I lived on campus. There were some commuters that lived a little bit closer to campus. And I just wanted to take advantage of everything that it offered because it was just all new, wild, exciting experience. There were people from all parts of the country, a lot of people from the New York City, Long Island area, which I had never had any encounters with. So a different cultural view. There were certainly many wealthy people, which was new for me. And so I encountered new types of individuals from multiple backgrounds and just opportunities to explore educational alternative, different classes, but also clubs. And I decided I wanted to join a fraternity. And that opened a whole new social experience as well. So I just embraced the school and the opportunity, but it was overwhelming when I first got there.
Yeah, I remember having been from a small town as well. I remember feeling like everyone knew more than me and had more money than me and more life experience and so on and so forth.
Yeah, definitely felt that, with the exception that I always prided myself that no one should know more than me. Now, I don't want to be egotistical. It would just mean that if they did, I'd have to learn so that I could catch up and be on par with them. So I just made sure that I did my research to try to at least stay on par or better on that front. But certainly people had more money and more world experiences and have traveled the world more than I ever had done. So I was going to learn from them.
Interesting. What did you study at Union?
When I first got there, I wasn't really sure what to study. I thought about going to law school because, again, in my little world, lawyers seem to be successful people. And I felt that, if I'm going to go to college, I should, get something out of it and try to have a good living and be successful. So I thought, well, a lawyer might be a good idea. So what should I do to have a adequate pre-law education? And that was political science. That was a more common route. So I started taking political science classes, but I also liked economics, or I thought I would. So I took an economics class. And Union was a trimester. So you only had 3 classes to take in any trimester. So you took 9 courses for the year. So I took a political science class, took an economics class, and I loved history. So I took a history class and just saw how it would go. And as I progressed, I did very well in economics. Political science was a little bit tougher. Coming from upstate New York, I did very well on my SAT math, not so well on the verbal side. In upstate New York, kind of struggles on the verbal side. It's just not, this didn't teach well in that area. So, political science, I would get a B in, and economics, I would get an A in. In history, I'd get like a B or an A. So I kind of bounced around. And then I was more quantitatively oriented. So I took math to get an A to get my GPA up. And I took one in like engineering for social scientists class to get an A. So I try to augment my GPA with economics and a quant type class, math, or that one engineering class, or something fun, and then get my B in political science.
So at what did you graduate with? Were you an economics
So I ended
major?
up, I think my second or third year, I became a political science major, and then I became a double major of political science and economics.
Okay.
So that was my degree at graduation, political science, economics. And then in speaking with my advisor, when it came time for law school or graduate school, we chatted, and he said, "Have you considered business school?" And I never heard of a business school in high school. It just an MBA was a foreign degree to me. But when I was in college, I learned what that was, obviously. And he said, with your, quantitative aptitude in economics, you might want to consider getting an MBA because you'll get into a much better business school, perhaps, than a law school. And then if you still wanted to be a lawyer with an MBA, you'll get into a much better law school. So I said, oh, that makes sense. So I took the GMATs, did well on them, and applied to business schools.
Where did you apply?
Probably the beginning of my senior year. So I think that's when applications usually went out, was fall semester, senior year.
Do you remember what schools?
I applied to 3 business schools. I applied to Harvard because, that was considered one of the top schools. I applied to Cornell, and then I applied to Duke. And I embarrassed to say Duke was my safety school because I did well on the GMAT. So, and I had the GPA. Harvard, I got into Duke and Cornell, and Harvard said that they wanted me to work for a couple of years and reapply because back then it was common that one would work before you went to business school, except for Cornell and Duke both accepted me without any work experience. So I decided, well, then I'll go to Cornell. And it was in upstate New York as well. So it was close to home where I was still kind of wedded to upstate New York. So it made sense. And then when I got to Cornell, I just excelled at finance and accounting. When I got there, they offered placement tests for different courses to see if you could place out of required courses. So I was an economics major, so I took the economics and placed out of that. I took, I think, statistics. I placed out of that. I even took a psychology test, and I had never taken psych or sociology at undergrad ever in my life. And I placed out of that because to me, it was all common sense answers. So I just said, what the heck, I'll take every placement test and see what I place out of. So I actually placed out of, I think, 4 out of my 5 requirements for the first semester. So I was then in second semester courses, and I did well in finance. I got an A+ in it. So the professor asked me to be a teaching assistant for my second term. And it was fun because I became a teaching assistant, and all my friends who had to take the required courses in the first semester were now my students in my finance class. So I would grade their exams and tutor them and so forth.
Mm.
So, I just got a kick out of doing that. And I did well in another finance class. So they asked me to be a TA. So I was a teaching assistant for 2 different finance classes, and I got paid to do that. And I needed to work. I worked summer jobs to pay for college living expenses. And then to go to Cornell, I did not have a full scholarship, so I had to pay tuition, and I had to borrow student loans. But I figured out the way it worked then is if I was an employee of Cornell and I was a teaching assistant, but it wasn't quite enough, so I got a job in the financial aid department where my friend and I would analyze financial need for prospective students or students and determine their scholarship or loan needs and make recommendations for those kids. I became an employee of Cornell, a part-time employee, which made me eligible to join their credit union, which paid a higher interest rate than a typical bank. So I drew down my entire student loan and put it in the credit union at a high interest rate. And back then, you didn't pay interest on your student loan until you graduated. So I had an interest-free loan for, 12 plus months, making the arbitrage with very high interest rates that existed in 79. It was the Carter era, double-digit inflation and 20% prime rate and so forth. So I made some money on the arbitrage by being a member of the credit union. And that's how I helped finance my education.
That's a great story. You were doing arbitrage in college.
I had to. I wasn't a wealthy person.
Oh my gosh. So then what happened?
So then it came time to look for jobs. And while I was at Cornell, I decided, well, I'll take a class at the law school to see if I want to be a lawyer. And that was one of the best courses in my life. It was partnerships, corporations and partnerships. And I enjoyed the class, but it became evident I really didn't want to be a lawyer. And I enjoyed finance. I did well at it. I took enough accounting courses to be a CPA, but I knew fairly early I didn't want to do that. So then I thought, well, what kind of business or company do I want to go work for? And it was hard because I didn't have real world experience. I never had what I would consider a real job. I worked construction in the summer, and I was a dishwasher one year, worked in a factory, but nothing that would be a long-term career for me. So I thought, well, if I go in the investment field, I could look at a whole bunch of different companies in different industries. And then when I found one I liked, I'd go get a real job. So I thought, well, I'll apply to be in the investments, and that will always be interesting because I can look at a variety of different companies. And then when I find a good one, I'll go try to get that job. So that was my plan. And having taken the corporations class in law school, I learned a lot about structuring corporations and legal documents associated with corporations and case law and so forth. And I was offered a job at New York Life in their investment department. And it was very intriguing because it was private placements. And unlike my friends that were getting jobs in the equity space or investment banking jobs and so forth, where the mantra was almost like, forget everything that you learned in business school. This is the way we do it at XYZ company or this investment banking firm and all that. Going to New York Life, I was getting access to CEOs and CFOs of companies that New York Life was going to be the largest or major lender to. So we had that intimate access with management teams, could tour factories, could tour locations, company locations, get non-public information because we were making loans, and it was fascinating. And I could read the legal documents, the loan documents, and craft covenants and so forth. And then it was 1980, 81, and there were a lot of financial challenges for the economy. As I said before, inverted yield curve, high interest rates, a recession, and so forth. So New York Life was organized by industry sectors. So I was in the transportation sector and the finance sector and the steel sector at one point in time. And we were responsible for making new loans, monitoring existing loans that the company had, and restructurings. If a company tripped a covenant or went into default or bankruptcy, my group, which was a small group, had to handle it. And I got involved in restructurings in the very early 80s. And it was an interesting time because the law that we operate under right now, the Bankruptcy Code of 1978, was passed in 1978 by Congress and went into effect in 1979. And I started my career in 1980. Well, all these restructurings were now governed under this new bankruptcy code, which replaced, I believe, the Bankruptcy Act of 1898. So the law changed, and the lawyers were trying to figure out how this new law would work. And the investment people like myself were on par with the lawyers because no one knew how this new law would actually work in practice. So we would get involved in restructurings and together try to figure things out and create legal precedent. So it was an early, fortuitous time to get into restructurings. And because of my restructuring experience at a very early age, I mean, I started right out of business school. I think it was 1980. So I was, 23 years old. And within 2 years, I had been promoted several times and I became assistant vice president at New York Life, which was a responsible position. I had signing authority over loans and so forth. And I actually chaired a creditors committee, a restructuring, and got a lot of experience at an extremely young age.
Mm-hmm.
So if people remember, that's when junk bonds were starting to come into their own. And I got approached by Drexel Burnham, Mike Milken's firm, who a Drexel salesman would call on New York Life to see if we would want to sell any of our positions. And we never did, but I talked to this guy periodically. And he introduced me to a job opportunity at First Investors, right on Wall Street in Manhattan. And they were looking for a restructuring expert. And there were very few of us there that existed because the law was new. So I fit the bill, interviewed, and was hired. And First Investors was the largest junk bond investor in the world at the time. It managed over $1 billion. We call them high yield bonds today. When the high yield market was maybe 20 or 25 billion in size. And they therefore owned every deal that was out there because they were like 4 or 5% of the total market. And Mike Milken was our salesperson. So I would talk to him every other day. That's how we bought and sold bonds. And being at the largest junk bond firm in the world meant that if a company got into trouble, we were typically the largest bondholder. And I was the one person that had restructuring experience. So I got in charge of the restructurings for the companies that we were invested in that had turned south. So I became chairperson of the Continental Airlines Creditors Committee. When Frank Lorenzo, who was the CEO, put the company into bankruptcy to break the union contract and become a non-union carrier because he was losing money competing with non-union carriers like Southwest Airlines, and felt that the only way to save the company was to break or abrogate the union contract. And so he put it into bankruptcy, broke the contract, became a non-union, low-cost carrier, and I was chairperson of that creditors committee. And the bonds were obviously trading at a big discount when they had filed, because the conventional wisdom was that an airline could not fly if it was bankrupt. No customers would fly them. And Braniff Airlines, that I had worked on when I was at New York Life, had liquidated because of that belief. Well, Frank Lorenzo said, we'll fly. And customers did fly. He cut the prices. We learned that people will fly the lower cost airline because price is more important than many of the other qualities of an airline. And they returned to profitability, and it turned out to be a 100-cent plan. So we made a lot of money on our Continental Airlines bonds that were at massive discounts because they thought the company was going to liquidate. And it turns out that it survived and prospered, and it was a 100-cent plan. And I was chairperson of several creditors committees in other industry sectors when I was in my mid-20s. So it was a tremendous opportunity. And to kind of digress a little bit about what happened in the finance world at the time is the bankruptcy code continues to evolve. And I was blessed to be there at the start. And when Continental Airlines abrogated the union contract, well, the union lobby goes to Congress and says, wait a minute, this is wrong. You can't do that. So Congress changes the law to say that you can break other contracts like leases and vendor supply arrangements, but you can't break a union contract anymore. So because of the Continental Airlines experience, they changed the law to prevent that from happening again. The other thing that kind of happened was Braniff Airlines, as I mentioned before, had gone bankrupt. And the beauty in America of a bankrupt company is it generates a lot of tax losses. To go bankrupt, you typically have to lose money. And in America, if you lose money, you have a tax loss. And if you ever make money in the future, you can apply that loss to shelter future earnings. Well, what you could also do back then is you could sell those tax losses. So you take the Braniff tax losses and you call up, and I'm making this up, you call up Exxon, which was Esso at the time, or Exxon, and say, I have a $10 million tax loss, which would shelter $10 million of your corporate earnings and save you, $4 million or $3 million of taxes. How much will you pay me for it? So you pay me $2 million for it. Because you're going to shelter $3 million of taxes. So it's a win-win. And so we started selling tax losses. Well, Congress then looks at it and says, oh my God, we never intended this. So they changed the law on transferability of NOLs, net operating losses, to restrict how you can transfer them and how quickly you can use them over time to prevent that type of transaction from occurring. So just a couple of examples of where I was involved that led to significant changes into the bankruptcy code and the way certain companies operate. So it was, again, a very creative time where I could apply the skills that I learned in business school in the real world and not have someone say, forget what you learned in school, this is the way we do it. There were no rules. It was brand new. The slate was, it was a clean slate. And we could just be as creative as we wanted until people said, we got to change the rules because that's not what we intended. So that was a very rewarding time in my early career.
What happened after that?
Well, then junk bonds became high yield bonds, and they became more acceptable and more attractive to retail investors. So T. Rowe Price in Baltimore wanted to start a high yield fund, and there were very few people with high yield experience. So they searched and recruited me to go down to Baltimore in 1985. I was 28 years old, and I helped them start up their high yield operation. They were a conservative shop at the time. They were primarily equities, but they did have a fixed income department that was all investment grade, very conservative, and munis. So high yield was kind of the pariah, and they were unsure as to what to expect when I got down there. But it turned out it was one of their fastest growing mutual funds ever. By the time I joined, the mutual fund was maybe 3 or 4 months in existence. It already exceeded $100 million. The money was just flowing in. So I got down there and worked with a high grade, an investment grade portfolio manager that they moved over to run the high yield fund because I was only 28. And I was the high yield expert and the only credit analyst they had. So they gave me a couple of young guys to help me out, and we ran that high yield fund. And it grew substantially. I hired a buddy of mine that I worked with at New York Life that went back to Chicago Business School. And when he got his MBA, I hired him down at T. Rowe Price to build out our team. And we did quite well. We won a Lipper Award as the best performing high yield fund in the country, and got a lot of favorable PR. So in 1990, Fidelity recruited me to come up to Boston and gave me an offer I couldn't refuse. I would run their flagship high yield fund, the Fidelity Capital Income Fund. I could invest a portion of it in distressed and bankrupt companies as well as high yield companies. And then I also co-managed the bankruptcy and distress investment operation that they had. They had a fund that they raised with no one with experience to run it. Fidelity was a money raising machine. So they actually had a fund with no portfolio managers at the time I got there. And we intentionally targeted companies that were in financial trouble to buy their bonds and loans. We bought bank debt as well, which was unprecedented at the time, at substantial discounts to what we thought the enterprise value was, and then restructured these companies, delevered them, got them back on their feet, and sold them. So we did a number of deals. We were one of the largest investors in the space, and the money just flowed in. I won a Lipper Award for the Capital Income Mutual Fund, as again the best performing high yield fund in America, and had great returns in the distressed investment area as well. But as we grew, we became more controversial, and we're starting to get a lot of attention from the press. There were my partner and I, Dan Harmetz, and I were profiled in the Wall Street Journal. We had our picture in there. One of those sketches that they did. So we got ridiculed by our friends. But some of our transactions were written up in the New York Times as well. We were involved in restructuring Macy's department stores and selling it to Federated department stores. I restructured Zales, the jewelry retailer, and got it on its feet and made a lot of friends in the jewelry industry because Zale was the largest retailer, and virtually every jewelry manufacturer was a vendor that got into trouble because Zale couldn't pay them back, and then they were stiffed effectively on their receivables, and their banks were pulling their lines. So I then restructured a number of jewelry manufacturers. I did oil and gas restructurings and, many others in many other industries. And again, it was fascinating. Very few people had the experience that we had. And the returns it was great. But as Fidelity got profiled in the press, it made Ned Johnson and management uncomfortable because we would have to take some aggressive action sometimes as a creditor that wasn't paid, and people would get angry. But a lot of it was posturing because it was bankruptcy. It's an adversarial process. You have different creditors with different interests, collateral packages, fighting with each other for a limited pie of value. and you had to protect your rights. And we're representing our shareholders and our investors and want to do a good job for them, get a good recovery. So in a zero-sum game, somebody else gets less of a recovery. And the PR was sometimes less than flattering for Fidelity. And Fidelity's primary business was equity investing, and they wanted companies of America to speak with their equity analysts and be candid with them as they did their equity research. And they didn't want a reputation of being hard-nosed or aggressive, because that might damage the franchise that was very important to them, to be a friendly investor that wanted good information from companies. So they started to limit our ability to invest, but I'd still be tasked with trying to produce good returns, but then be challenged on what we can do, trying to pre-clear investment opportunities before we made them, just in case an equity fund was involved, to give them time to get out of the investment before we started buying and so forth. And the world didn't wait for us to get our ducks in a row. The prices moved and it became frustrating. So my job got more challenging. And then as we grew so big, because in addition to running the capital and income fund and the distressed investment area, I also had a $500 million allocation from the Magellan Fund, because it was the largest equity fund in the world at the time. And they were struggling to find good stock investments, and I could find good high yield and distressed investments that made sense for the fund and had equity-like returns. And so my pile of money was growing, and it became more challenging to take advantage of the opportunities that existed in the credit markets. So Dan, Judy, and myself decided it might be advantageous to leave Fidelity and start our own firm, a little smaller firm, to take advantage of the inefficiencies we saw in the credit markets, but we're somewhat capacity constrained. We couldn't run $10 billion in this space and generate alpha. We needed a smaller pool of capital, needed to be more nimble, and needed to fly below the radar. So that's when we decided to depart Fidelity. It was an amicable separation. They understood the reasons. And actually, we entered into a consulting arrangement where we continued to manage the limited partnerships that we were responsible for at Fidelity. And it was a source of revenue when we started DDJ. And DDJ was Dave, Dan, and Judy, our first initials. And that's how we started DDJ in 1996. And then Dan left in 1998. And Judy and me, when we first started DDJ, said when we reached age 50, we would retire. And that was 10 years later. She turned 50. I turned 50. She was a month younger than me. And she said she wanted to retire. And I said, I don't. So I bought her out. So I was the last surviving D of DDJ. So long-winded way of how I got to DDJ.
I would not want to owe you money.
It's simple, just pay back. It's a contract. And, the way I look at it is, if somebody borrows money from you and doesn't pay you back, it's no different than stealing. Mm-hmm. It's like the lender is not the villain. Mm-hmm. I mean, nobody puts a gun to somebody's head and said, you got to borrow money. Mm-hmm. People come to us and they want to borrow. We question them and we're diligent. We challenge them and say, is this a good idea? You got to demonstrate to us that you can pay us back. And if they do all that and then they make a mistake or they fail, it's on them. It's not on us. No. I take the view that, we're lending you money. It's an agreement, and you're going to pay us back with interest, because if you can't, I'll lend money to somebody else who will.
Right.
So I'm not the villain.
No. That's not what I meant at all.
I know. But in America, we have this sympathy for creditors, and it's actually somewhat unique to our culture. We have a bankruptcy clause in the Constitution.
Wow.
Most countries don't. And it's been beneficial to the way the United States has grown, because without clear insolvency laws like a bankruptcy code, lenders don't know how they're going to get paid if things go wrong. So it might not be the best rules, but as long as there's rules, it gets lenders comfortable to make loans because they know that there is a procedure that applies if things go wrong. Many countries did not have insolvency laws and still don't, or they're unclear, or they're not fair. And therefore, a bond market can't develop. A robust lending market and capital markets can't develop because there are not set rules to the game, and it's held back their development. The United States prospered because, I believe in part, it had defined insolvency laws and rules of the game. People forget, at the turn of the 19th century, Argentina and the United States were on par with one another statistically. You know, the similar climate, natural resources, social norms, and so forth, GDP per citizen, and all that. And they went in two different directions. And I like the United States approach: clear rules of law and property rights, and not a corrupt government. And it matters. So I take pride in insolvency laws and living up to what the rules of the game are.
Yeah, me too. And a lot of people also forget that the bond market dwarfs the equity markets.
Yes, there's more debt out there than equity. And now it includes a lot of things like government debt. And right now, government debt dwarfs all markets, and that may not be a good thing. And we have to contend with how that debt will be serviced over the next couple of decades. But credit is fascinating, more complex than equities, more diverse than equities, and definitely more creative than equities. And people overlook it. So my one advice to students who want to get in investments: consider credit. There's structured product, there's mortgage-backed securities, there's investment grade, below investment grade, municipal, tax exempt. There's infrastructure deals, there's sovereign debt, emerging market debt, and loans, bonds, private debt, public debt. It's a vast, interesting market with a lot of opportunity and a lot of space to be creative.
Mm-hmm. So when you recently decided that you wanted to sell your firm, how much did you have under management at that point?
We had probably a little over $8 billion under management. I mean, we were good size for what we did. Certainly, we wished we were a little bit larger. The world changed a lot, and our industry changed a lot. When I started DDJ in 1996 versus where it is today, I mean, we used to comment with other people in our industry. Back in the 90s and early 2000s, the asset management space was a great business. Today, it's a good business. It's gotten more regulated, more challenges, growing pains, and so forth. Bernie Madoff certainly had a big impact on the skepticism associated with asset managers and so forth. And then the growth in technology. We have to spend more on IT and data security and so forth, as opposed to just trying to make money for our clients. You have to protect their information, and there's villains out there in the world that are trying to do bad things. So it creates more regulation challenges and costs to doing businesses. So it would have been much harder. I don't know if I could have started DDJ today than it was in 96. So as the challenges of the business world evolved, when I started DDJ, if you were a good if you had a good track record, you generated investment alpha. The money found us. Like I didn't even have salespeople when we started. The money just came to us. And then with the skepticism after Bernie Madoff and other factors, it became more challenging. You had to have a nice office. You couldn't be in the strip center anymore. You had to spend money on certain accoutrements and so forth to put on the appearance that you weren't a shyster of some sort. So it created growing pains, if you will. So just having good investment results was not enough. You had to have a good middle and back office, which we always did. You had to meet the needs of demanding clients that were asking for more and more data on performance attribution, how you generated returns, and you acquire more sophisticated software to meet those needs and so forth. And we were an investment firm, and we were spending more and more of our resources on non-investment infrastructure. And we were not an IT firm, but I had to hire IT people. And then to grow our AUM, our assets under management, I had to hire salespeople and client relations. We got more clients and so forth. So you had to have people managing those relationships and meeting their needs. So we had to build out a whole robust team to where we had over 50 people. And when I started, we had less than a dozen, and everybody was an investment person, and the dynamic sort of shifted. So distribution became more important, and the infrastructure support became more important. And the clients now were looking not for investment boutiques, but for more wholesome solutions to their investment needs. They didn't want to have 30 different boutiques that were experts in their own space. They wanted more one-stop shopping, a firm that could handle a broader array of investment needs. So we knew at some point that we had to associate with a larger company that could handle our infrastructure requirements, our IT needs, and have distribution capability, which was not our forte. In the old days, we waited for prospects to call us, and they'd see our numbers in the database and say they wanted to be a client. And we ended up with billions of dollars from non-US clients. And people ask me, how did this little firm from Waltham, Massachusetts end up with several $1 billion from Dutch and Finnish and European clients? And I said, they called us up. And because they're less concerned about a brand name, they want investment results, and we produce investment results. Whereas Americans were a little bit more focused on brand names and what I would call career reputational risk. If they hired a boutique to manage their money and something went wrong, they could lose their job. But if they hire, BlackRock or Fidelity or, Vanguard, and something goes wrong or they have underperformance, they say, well, everybody else hired them. They're not going to lose their job. So it became more challenging for a boutique to operate in our space. So we were approached by over a dozen firms that wanted to buy part or all of us. And when Poland came along, I had the fortunate experience of meeting with so many other firms and learning what didn't make sense for us, the lack of a cultural fit, the lack of legitimate distribution capability, the potential they tamper with our investment process or tamper with our team. And Poland had a very similar corporate culture as we do, which is a whole nother story. But so we had that in common. We had a common investment philosophy of generating alpha, investment results for our clients. We don't want to hug the benchmark. We don't want to be average. So many investment managers and clients just want average. And that could be good for their needs. And I'm not going to criticize it. But there is a cohort of prospects and clients that want more, and they want strong investment performance that outperforms the benchmark. And Poland has that philosophy, as do we at DDJ. So it was a perfect fit. And the transaction occurred almost 2 years ago, and I've been pleasantly surprised. You never know how a transaction would go until after it occurs. And I've been involved in many restructurings in corporate America, and many of them are the result of failed acquisitions where the cultures didn't mesh, the systems didn't mesh, and everything sort of came together nicely with this one, and we all became friends. So it's worked out very well. And for me, as I'm at the near the end of my career, I wanted to find a good home for all my people. That was critically important. Poland took every single person, assumed our office lease, and then is providing tremendous support to help grow the credit franchise. They have resources that I didn't have as a standalone firm, and it's providing growth opportunity, career opportunity for all my people. And that's so important because they're happy. I've had people that work for me or with me for 20 years. You know, the investment tenure is somewhat unprecedented in our industry. I've got senior people who've been with us 10, 15, 20 years. That's rare. And there's a reason for it. They like what they do. They're good at what they do. We enjoy each other's company. And that continues as part of a larger Poland with more resources that can provide the growth, professional growth opportunity for all our people. So I'm pretty happy with how things have progressed.
Great. It's got to be gratifying.
It is. It is.
So what's the next chapter for you, Dave?
Well, I still have a little gas in my tank.
Okay.
I told Poland at the time of the acquisition, where I want to be is when we reach capacity in our capacity constrained investment products, where a prospect comes and they want to give us money and I say, sorry, you're going to have to wait. We don't have room to take your investment. So when I get to that point, then I can say, thank you. I'm in a good place and my people are in a good place. So we're building out, broadening our strategies to be a more full service, alpha generating investment firm. That's critical. We want to be not average. We want to be better than average. So we're going to continue to generate the outperformance we've produced in our current strategies and then broaden the vehicles that we can deliver these strategies so we can deliver it to additional audiences. Historically, our clients were institutions, insurance companies, pension plans, sovereign wealth type clients, and sub-advising on large mutual funds and some platforms. But we want to deliver now to the broader RIA network and platforms, high net worth platforms, have mutual funds so people can put our products in their 401ks if they so choose, and deliver the capability to a broader audience because it's good. We think we can deliver value, but it makes our organization more sustainable. When you have a narrow client base, and we almost got into trouble when our largest client went bankrupt in 2008, 2009. It was, more than 25% of our assets. And the PBGC was going to take their pension plan over, which they ultimately did. So we knew we were going to lose, a quarter or a third of our revenue if we didn't replace the client. So we needed a diverse client base to provide institutional stability, which is good for everyone. And Poland has the resources and the network to do that. They're very good on the platform side. We're very good on the institutional side. So it's a good combination.
So that's an indeterminate sort of an answer.
A couple more years and I'll start traveling more. I love history, as I said at the outset. I love to travel.
Mm-hmm.
I can do it from a business perspective, but there's usually not a lot of free time. to enjoy my trips. I think I'm going to Europe, 4 cities in 5 days the first week in January, and then I'll go back 4 cities in 5 days the last week in January to do roadshows to talk to prospects and clients. And I enjoy the travel, but I like to go to more fun places and spend a little bit more time there. So I do have a 2-week trip planned in May to go to Northern Italy, and I'm looking forward to that. And I'd like to do more than 1 2-week vacation a year. I'd like to get a couple of those in every year, and then maybe a few more, and see if anybody notices I'm gone.
That's funny. Is there anything that we're leaving out? Anything we haven't talked about today that you feel is important about your career and your life?
Well, I do like to touch on philanthropy. I mean, that's been important to me as well. As you know, I'm a trustee at Union College and also a trustee at Cornell. And you become a trustee because, you spend time and give back. I do lecture in classes at Cornell and other business schools in my field. And I get a pretty good turnout from the students. They find the course pretty interesting. And I've done a lot of volunteer work for Union, but also if you donate money. And what was important to me, as I said earlier in our discussion, I benefited from a substantial scholarship to go to Union College. And I vowed to myself as a young kid that if ever I was blessed to be in a position to give back in a similar way, I would do it. And so I worked hard in my life to make a few bucks. And I gave to the annual fund almost every year since I graduated in small gifts, and that got increasingly larger. But when I got to the point where I could make a more meaningful gift, I welcomed the opportunity and established many scholarships at both Union and Cornell. And, they'll put my name on a building, but it's really, I didn't build the building. I gave a lot of scholarships. And as part of how universities work, they like to recognize somebody for that to encourage others to do the same thing. So it's sort of a marketing ploy to get others to step up to the plate. And that was important to me. And I do advise students on careers. I get calls all the time from Union College, Cornell students and others for career advice and, help them make decisions. I talk to kids that are applying to the schools and, give them advice as to what it was like, the pros and cons of the schools, how it, benefited me, and, might it be a good fit for them, or just give them some information. So that aspect, and I established a charitable family trust where I make gifts, and I do a lot of gifts anonymously. But I felt, all people should give back because we've been fortunate and we received opportunities that others, quite frankly, just don't have the same opportunity. And it's a shame because they're bright kids that need that opportunity. I was a trustee at the Children's Trust in Massachusetts, whose mission is to eliminate child abuse because, we got to intervene and help kids at a young age, because if we don't, a handful or a significant portion of them are going to find their way in the judicial system not in a favorable way because they just weren't given a fair shake in life. And it's a cost to society and a cost for those individuals. So, virtually over 90% of the people that are incarcerated have been abused as children, and haven't been given an opportunity that we have. So why deal with that when you can, give the vaccine up front instead of dealing with the illness at the back end? So address the issue when the kids have a chance of a better opportunity than deal with the aftermath of a bad opportunity or a lack of opportunity. So my philanthropic efforts are devoted to helping children and kids with scholarships and get that educational opportunity that will help them forever. one thing, you can't take away an education. So that's one of the best resources society can give its kids. And
Agreed.
I'm a proponent of it.
One last question, and
Yeah.
I ask this a lot. The most important punctuation in the English language is the hyphen between your date of birth and your date of death. What would you want people to know about Dave Breazzano?
That I had an impact, that I left the world a little better than when I came in. I gave back. I'd hate to go through life and be totally forgotten and have no impact. So I hope that, I can improve people's lives, society's lives in some fashion.
Well, my opinion isn't necessarily called for, but in my mind, you've had a huge impact on me, if nothing else. Thank you for
Well,
that.
thank you, and it's mutual. I mean, we all
Thank
get
you.
something out of our relationships.
Mhm.
They're not one way. So I've enjoyed getting, knowing you for as long as I have and spending time with you.
Thank you.
And then, the things, you know my kids now.
I do.
That's pretty cool.
It's nice to see how well they're doing, for sure.
And, when they're little, you don't know how they're going to turn out. So
No,
I am blessed that they turned out well.
no
I'm
doubt.
really proud of that. And I want to lead by example. And, Mike is my middle son, is a junior trustee at his undergrad school and has created a couple scholarships at Cornell and UVM.
Oh, wow.
So, that makes me proud.
No doubt.
So, it hopefully continues.
Amen.
So
Well, thank you so much, Dave. I hope you have a Merry Christmas, and I appreciate you doing this. Thank you.
thank you, Pat, and Merry Christmas to you as well. And thanks for having me on.
You got it. Take care.
Take care.
If you enjoy the most fascinating podcast in the world, please follow on Spotify, subscribe on YouTube, and follow on Apple Podcast.